credit. No, no. Cash, increase, debit. Debit, increase asset. All right? And then increase revenue, right? Increase revenue, credit. Credit. A, journal entry, cash, 20 grand. Debit, boat repair services, credit, 20 grand. We got here a T account. We got a T account. So we got our beginning balance. Our beginning balance flowed from less than 2. We're going to carry that forward. Beginning balance, beginning cash is 25 grand. Let's add another 20 grand, A, because we just received 20 cash. And then let's increase, okay, boat repair rentals revenue. A, increase, beginning balance was 0. This is the first transaction. A, 20 grand. Let's increase credit, right? Revenue increases with a credit on the right. So we have a one on the left, one on the right. Yep. All right. Journal entry balances. Let's move on. B, sold $500 of gift certificates for boat rental in September. All right. Stop. Remember, accounting is easy. Did a transaction occur? Yeah, we received $500, and in exchange we gave him the gift certificate of a future promise to give him something. We're going to give him some services in the future. All right, so a transaction did occur. We received cash. All right, credit. No, debit cash, increase cash. Journal entry. B, cash 500 up. And then what? And remember, we're gonna owe him future services. We're going to owe him future services, so that's a liability, right? We're going to owe him something in the future. All right, so we're going to have to increase via if it's liability, the increase on the right, the credit increase on unearned revenue. All right, so B goes down here then to our T account. B, cash up 500, unearned revenue increase with the credit right there. B. All right, transaction C. Customers used $200. All right, so that customer used $200 of the gift certificate to pay for a boat rental in September. All right, so we're goods and services exchanged. Yes, we gave them a rental service. We gave them a service. Services were exchanged. They got the rental. All right, so what did we do? Rental. So we gave them a service, so we can probably recognize revenue. We gave them a service, right? It's, you know, you recognize revenue when the services are rendered. We just rendered the service, gave them the boat rental. All right, so how do you increase revenue? With a credit on the right. All right, so there you go, 200 up, and then we don't owe them the whole $500 now because we gave them 200, so we could probably decrease that gift card or unearned revenue by 200, right? How do you decrease the liability? With a debit on the left. Here you go. Down here, we put it on the T account. We put it on the debit side, and then on the revenue side, we put $200 down here. All right, moving on. D, provided $1,000 of boat repair services to a local ferry operator, which is billed monthly. Okay, so we provided services. All right, let's stop. Did it, remember, accounting's easy. Did a transaction occur? Yes, we provided services. So there's what are the accounts affected? Well, let's think about this. Services, okay, revenue, right? We provided services, we can recognize revenue. Okay, revenue increase, so we're going to credit revenue, right? Okay, boat rental, repair and rental, credit 1,000. All right, and say we're going to bill them monthly. They are going to owe us money. We didn't receive cash now, but they're going to owe us money in the future. Well, that's an accounts receivable. Going back to the balance sheet from lesson 2, so accounts receivable are something owed to us at a future time, so we're going to increase that asset. That's an asset, that's cash coming in. We're going to receive a future benefit, right? We're going to receive cash in the future. Asset, increase asset on the left side with a debit. So D, accounts receivable, debit 1,000, credit 1,000. Going down to our T accounts, see right here, on the left side we got D, increase accounts receivable 1,000, and over there we got revenue, increase with 1,000. All right, moving on to E, the ferry operator paid us 500 of his account. All right, stop. Remember, accounting's easy. So okay, did a transaction occur? Yes, we got 500 cash. We received services. We received goods. Right? We got cash. We got $500 cash. We got resources. All right, so so now what are the journal entries? What are the accounts? All right, we got cash. Cash probably going to increase. And what's the other account? Well, we recognized $1,000 accounts payable when the initial transaction, and we said they were going to pay us, but they paid us 500. So now they only owe us 500. So we'll probably have to decrease that receivable by the 500, right? So we're going to increase cash, debit cash, and then we're going to credit that asset because we received 500, and we only get the future benefit of that asset's now only 500. So we're going to decrease it by 500. So cash 500, accounts receivable 500. Let's go to the T accounts. You see E right here, 500, and then accounts receivable. We're going to put a credit on that, 500. All right. If you don't understand that concept, rewind the tape, go back, play it again. Lesson 3, we're going through these income statement transactions, but we're also going through some balance sheet as we recognize revenue, as we receive cash. All right. So there. Now we're going to move on to some expenses. F. We paid employees $10,000 for wages related to services they provided in September. All right. Stop. Remember, accounting's easy. Did a transaction occur? Were goods and services exchanged? Yes, we paid cash $10,000 and we received services from the employee of $10,000. All right, so we got a transaction. What are the accounts? Well, okay, as we said, we paid them cash, so cash probably going to decrease, right? Decrease on the right with a credit. Cash is going to decrease, and then let's see, salaries. We received a service, so that's probably an expense, right? We got benefit, and so we paid them cash, but that benefit we used already. We used in the month as as labor, so that's an expense, right? They gave us something, and in exchange we gave them cash, so we need to recognize expense. Remember, on the other side of the cheat sheet, we said, are we going to get a future benefit from that cash out? No, we already got the benefit, so we need to recognize the expense, right? No asset, expense. So debit, expense. Expenses increase when you on the left, right, with a debit. So we're going to increase right up here, wage expense, $10,000, cash $10,000. Follow that down to our T accounts. Cash is up here, decreasing. Expenses down here, increasing. G, we paid September, October, November pier and docking rent in advance at a total cost of $7,500. Well, these are transactions that are occurring in September. Okay, we paid September, October, and November. Okay, so let's stop, right? Remember, accounting's easy. How are we going to do this? Transaction. Did a transaction occur? Yes, we paid $75,000. There was an exchange of goods, right? Or $7,500. We paid $7,500. There's an exchange of goods, so there's a transaction. Now, what are the accounts? Well, I just said cash went out the door, so probably cash. We decrease cash, credit cash, right? Because cash went out the door. Okay, what else are we going to look at here? We paid it in September. We're still in September, so we're still receiving a benefit, and we paid it for October, November, so we're going to get benefit in the future. Remember, on the other side of the cheat sheet, we said, okay, is it a cost? Cost is incurred. We pay the cash. Now, does that benefit a future period? If it benefits a future period, then yeah, we recognize an asset. So, okay, this is going to be an asset, so we're going to increase an asset. Asset goes up, right? We're going to get a future benefit out of this. So, what's the journal entry? Prepaid rent, $7,500. Cash, credit, $7,500. Take it down to T accounts. Cash right there. G, cash goes down. Prepaid rent right here goes up, $7,500. We got an asset. We're going to get future benefit out of that prepaid. Now, moving on to H, we paid $1,200 for an insurance policy that covers Round Belly for the period September 1 until August 31 of next year. Okay. Okay, so let's stop. Remember, accounting's easy, right? Did a transaction occur? Let's think about this. Yes, cash went out the door. All right, so there's definitely an exchange of resources. Now, what are the accounts? Okay, well, cash went out the door, so it's probably cash, credit cash, right? Cash decrease, credit cash. All right, so now what do we got here? We got okay, so we go to the other side of the cheat sheet. We say we get incurred cost. Is there going to be a future benefit? Are we going to receive a future benefit from this? Okay, well, this is an insurance policy that's going for the whole year, starting in September 1 all the way to August. So we're going to receive insurance coverage for the whole year, so we're going to receive future benefit. Okay, if we're going to receive future benefit, it's an asset. Let's record an asset. Increase prepaid insurance, $1,200. Decrease cash, $1,200. Journal entry, debit prepaid insurance, credit cash. T account, credit cash, prepaid insurance, debit, $1,200. Moving on. I received a bill for $500 for running a radio ad in September. The bill will be paid in October. Okay, so we received a bill for running a radio ad. In September. Okay, so the radio ad ran in September. Did we receive a benefit? Okay, let's stop. All right, let's stop. Remember, accounting's easy. All right. So did a transaction occur? Running a radio ad ran. That helps us get customers. But that's a service that they gave to us, right? That service is running a radio ad. So yes, services were exchanged. Definitely a transaction. Now, what are the accounts? All right, we received a bill. We haven't paid it, so no cash went out the door, but we're probably gonna have to pay it, right? We say we're gonna pay it next month. what happens when we pay something in the future? Okay, that's a liability, right? That's a liability. We're going to pay in the future. That's a future obligation, liability. So how do our liabilities increase? Credit liability. All right, credit liability. That's credit accounts payable. It's something that we're going to have to credit, right? Because we're going to have to pay them. All right. But this is September. The radio ad ran in September. So are we going to receive future benefit? No, right? It already happened. It ran in September. This is September. We received the benefit. Expense, right? All right. So we're going to debit expense, credit accounts receivable. Go down here. Advertising expense, debit 500, increase. Credit accounts payable. Where are you? Down here at the bottom. Increase 500. And remember that T account, our beginning balance from lesson 2 was 800. Now we're going to put in the additional 500 for the radio ad. Our ending balance is going to be 1300 all said and done. All right, moving on though. J, paid utility bill totaling 1,000 for services received. Okay, so all right, let's stop. Remember, accounting is easy. All right, so let's determine if there's a transaction. Transaction, paid utility bill totaling 1,000 for services received. So we paid it. We paid 1,000. Cash went out the door. Resources exchanged. Services received. Definitely a transaction. Let's move on. Accounts. All right. Well, we know we paid cash. Cash decreased. Credit cash. Credit cash. That's one of the accounts. What else? We received services. All right. We received the services. In September. This is September, so we receive the services. Is there a future benefit? No, there's not a future benefit, so it's an expense, right? Expense, what type of an expense? Well, this is a utility bill, so it's probably a utility expense, so we debit utility expense. Debit utility expense, credit cash. Go down here, see our T accounts, debit utility expense, credit cash, all right? There you go. So those are the transactions. Remember, it's just like lesson 2. How do we do it? We start with the analysis of a transaction. Stop. Remember, easy. Let's follow the remaining 4 steps. Did the transaction occur? Goods, resources, services, exchange. Yes. Identify the accounts. All right. Create a journal entry. Record it. Then go to the T account. Make sure the T account's balanced. There's debit and credit on each side. Now, what we're going to do is, remember from lesson 2, I told you that we make a journal entry, and then the journal entry is each of those we make, and then the ledger is a sum of all those journal entries. And remember from lesson 2, the trial balance shows us the ledger balance at a given time for all of our accounts. Well, down here I've included a trial balance, right? And so we take our ending T account, and that flows into our trial balance, right? Because the trial balance shows our ledger balance at any given point in time for all of our accounts. Some of them could be 0, but as you see, if you flip your cheat sheet and you go to your lesson 2 cheat sheet, you see there's all these chart of accounts. There's all these accounts, but some of them have 0 balances. We've excluded the 0 balances. We've only included accounts with balances. That's right here. So we got cash 26,300, and I only drew one arrow, but you'll see all these were late. Supplies 800, accounts receivable 500, prepaid rent 7,500, prepaid insurance 1,200, so on. Now, I went through this fast. Hopefully you didn't take any notes. Don't want you taking notes because all your notes are right here. Everything you need to know is right here. If you need to go through it again, you didn't catch some concepts, just watch the lesson over. All right, so that's lesson 3.